Hey, hey everybody, welcome back to the weekly rebound balance. It's May 12th, and we're moving right along throughout the year, almost halfway done with the year now. Nick, how are you doing today?
I'm doing well.
Good. What do you think about these markets halfway through the year?
Been a wild ride so far, that's for sure.
It certainly
We've had our
certainly has been.
drawdown, we've had our recovery, and we've been chopping right along.
That's right. So what are we at now? Is that 6 weeks of weekly gains?
Yeah, that sounds right. That sounds
Yeah.
right.
It is, with all the volatility going on with the war and changes at the Fed and everything, a lot of uncertainty for a winning streak that's long. I think it's the longest winning streak since 2024.
Yeah, no, I believe you're right on that. It's been, like you said, it's really interesting to watch. I mean, there's certainly been reasons for optimism, but there's still a lot of uncertainty looming out there. So to see the markets recover the way they have has been really impressive, and just the continued strength as well. Just really, I think was surprising to most people.
Yeah, yeah, absolutely. The S&P 500, this was Friday, as a Friday, May 8th, but hit an all-time high, at least an intraday all-time high of 7,401. The Nasdaq new record close and an intraday high, 26,247, I think is what it closed at. The Dow Jones, I don't think it hit a new all-time high on Friday, but it's up there almost 49,609. And then we've seen small cap and emerging markets really have a great year as well. And that's been really a lot of the similar trade has come on in the last couple of weeks where you've seen the AI trade back in command, memory stocks doing very well, stocks like Nvidia continuing to be very concentrated in performance and grow in their size in the market cap weighted indices. But we have seen a shift in the equity returns where you've seen emerging markets lead the way and small caps actually outperform large caps. So that has been different this year. And even with the last couple of weeks where the AI trade has been back on, we're still emerging markets and small cap are far and away leading for this year. So at least so far.
Yeah, that's been a really interesting story to follow as well. Again, another one that I don't know, a little bit surprising. Again, it's lagged for a little bit. Emerging markets and small cap have both kind of lagged where people have expected them to be for a little bit now. So seeing a little bit of a recovery and making up some of that difference, not all that surprising. But when you put it in the context of, especially for small caps, where the Fed is largely expected to hold rates for a while, we haven't gotten any cuts. We don't really have any insight, so to speak, at this point. That the markets are pricing in, at least. Just kind of surprising to see that.
Yeah, yeah, definitely. Yeah, the 1 year return on the S&P 600 was, let's see, this was 35.42%. That was through, I believe, yesterday.
Wow.
And the year to date, 15.34%. And if you compare that to the corresponding large cap index in the S&P 500, I mean, even beating with the 1 year return. So 32.76% was the 1 year return in the S&P 500 and 8.88% year to date. So big difference year to date, but it's a little surprising to see the 1 year because that captures a good amount of 2025 where US large cap led the way by a significant amount. So it just shows you how really, yeah, that script has flipped a bit or quite a bit in the last 12 months, where small caps really starting to lead the way within the United States, which has not been the case for some time.
No, no, it hasn't. And we've touched on this too, but memory stocks, chip stocks in general. One of the things we had a call earlier today, and I wanted to highlight it, but last week the SOX index alone returned about 12.5%, which coming on top of the gains that they've already posted this year is just an astounding figure to
Yeah,
digest. Um, Again, another one of those things where a lot of these companies, suffered throughout the Iran conflict, and we were pretty confident that they would recover pretty quickly. That's just kind of the way things play out when you get somewhat of a resolution to that, and we've talked about that a lot. But I don't know that I would have expected we're at 8.8% for the year-to-date return on the S&P 500 this soon after,
Yeah.
being about 10% down on the S&P year-to-date.
Yeah, yeah, big flip there. Well, and there's been mixed news. We have we have great news in earnings growth. So the S&P 500 earnings growth has been stellar, far above expectations, which is great. But we've got some issues still. We got the war still lingering. That's certainly not come to a complete resolution. And we've got some uncertainty at the Fed as well. I mean, the Fed is grappling with quite a few different things. Energy cost and inflation issues, potential. We're getting a CPI print later this week. We've already got a lot of PMI data in, and there's some concerns, and you saw that in the fractured FOMC vote from the last meeting, where there's this caution on some sides wanting cuts, some potentially even wanting hikes. And the important part is division there. And you've also got Kevin Warsh taking over for Powell very soon. And that is, there's a lot of uncertainty around there. So I feel like the markets are in this kind of both fixed income and equity markets are in this proceed with caution tone. And just kind of seeing what happens with the war, at what happens at the Fed, and seeing if they can really proceed or not.
Yep. And we got CPI data today, right? I feel like it came in a little bit hotter than expected, especially for core. It was a little bit alarming for some. But yeah, I mean, just adds again to the uncertainty that's out there, figuring out what they're going to do. Definitely a difficult situation to inherit as a Fed chair.
Yes, definitely. Definitely a difficult. And I mean, again, that brings us into our research of the week. Yeah, we wanted to dive into regime change at the Fed and discuss, because Warsh, he really wants a different regime at the Fed than what has been the case the last 10 or 15 years. So I wanted to go back in history a little bit there and do some research, and also go through the 1951 Fed Accord.
Yeah, some interesting stuff in there for sure.
Yeah. Do you want to open us up on that, Nick? What's your thoughts on that?
Well, I mean, bigger picture, I think the big takeaway from going back in time and looking at the Fed and the relationship that it's had, just politics in general, is that while following the news recently with Trump and Powell and their confrontations that they had recently, maybe is a little bit surprising, at least to me. I mean, I haven't been investing for all that long. Only really been in the industry for coming up on 5 years now. But going back in time, if you look back at historical precedents, basically, the current president and Fed chairs have always kind of had a little bit of a butting of heads throughout history.
Yes.
And that's really what we get with the 1951 Treasury Fed Accord. And then also, I mean, there's just several other examples of where the current sitting president wants the Fed chair to lower rates. And they go about it in different ways in trying to exert influence over the Fed chair. But certainly not a new thing. Maybe just it's easy to forget the history there.
Yeah. Well, and actually, I mean, since 1951, the Fed has been independent. But before 1951, the Fed was certainly at least not meaningfully independent from their political counterparts. So, I mean, should we unpack the 1951 Fed Accord first, maybe?
Sure. Yeah.
You want to do that, Nick, or do you want
Sure.
me
I mean, I'm happy to. I think the big thing is basically we're coming out of World War II, and throughout that period of time, the government needed to borrow a lot of money to support the war effort. And in order to do that, basically yields on treasuries were, or not treasuries, yields were kept basically to keep borrowing costs low for the US government so that they could sustain the war. Coming out of the war, when you need less of that money flowing into the system, supposedly, again, because you're out of war, you're supposedly spending less, that sort of thing. you would think that that yield cap could go away so that we could return to a more normal state where the market determines yields, or at least they can fluctuate a little bit more. The market's in conjunction with the Fed. Um, and so basically in 1951, that was the end of that yield cap, uh, allowing the Fed to move interest rates around again, because through World War II, they weren't able to do that.
Yeah, exactly. It's basically war finance. And when you think about it, it's World War One plus World War II, and then 6 years after the end of World War One, where the peg was, I think it was 3/8% on short-term treasury bills and 2.5% on the longest term bonds, which I believe were 30 years at the time.
Mhm.
And that was essentially just to keep the government borrowing costs low. But then what the crazy problem was inflation went like crazy. So
Yeah.
I think 1946, 17.6 was the CPI number. So 17.6% inflation 1 year in 1946, 9.5% the year after. And then we went back to war again in 1950 with the Korean War, and inflation surged again. And that was the highest metric of all of those years. I think it was 21%,
Yeah.
1951. So that's where I think it was Chairman Thomas McCabe and I think it's the Bank of New York president Alan Sproul decided that they were basically they had to break that
Mhm.
trend. And Truman was very
Yeah.
staunchly against it.
Yeah. Yeah. Well, it's tough, and there's always, that there's been a lot of criticism of presidents throughout history, even after that, just pushing the Fed to cut rates going into an election because, again, they want the cheap money, they want the party to keep on going, um, don't want hard times to start coming right before election day. So there's been plenty of other presidents that have not been happy about decisions, but yeah, that was a pretty firm breaking away from um, control from the president at that point.
Yeah. Well, and Truman ended up replacing McCabe. So Thomas McCabe was the Fed chair. After all of there's this whole dramatic exit, basically. I think if you read the story, that the White House came out and said that the FOMC has pledged its support to President Truman to maintain the stability of government securities as long as the emergency lasts. And total lie. There was no such promise there. So then they basically leaked the actual minutes, and that set off this whole thing where ending with Thomas McCabe forced out as the Fed chair. And then Truman did replace him with William McChesney Martin, and who had actually negotiated the deal, the 1951 Fed Accord with the Treasury, from the Treasury side. And Truman expected him to be his ally. And basically, Martin asserted Fed independence anyways. And there's this story that apparently Truman crossed, I don't know if it's true or not, but Truman crossed paths with Martin in New York. And he stepped up to him and said he just called him a traitor and walked
Yeah.
off.
Yeah. I mean, it's crazy. And then, it's funny too, just following up with other historical episodes since then. I mean, when you get into Arthur Burns and Richard Nixon as well, even following that decision that had been made, which was a pretty clear breakaway from the central bank being controlled by the government um, directly, or having too much influence from the president. You've got a quote from Richard Nixon from the White House tapes where he said, "The Fed is not really independent, it's quasi-independent. In the last analysis, it has to go along with the White House. I intend to see to it." So,
Yes.
and again, I mean, that's another famous incident of where, the president was exerting influence over the sitting Fed chair, and Burns's um, diaries that were published after he passed away talk about him, kind of caving to that pressure. So it continued from then on as well. It's just, there wasn't an explicit cap on anything, or I guess they had to go about it in a little bit more of a shady manner. But it's been interesting to watch the other ways that presidents try to influence the central bank and how it should be in its ideal form, independent.
Yes, yeah, absolutely. Well, and that brings us to Warsh, and he has some pretty notable regime changes that he'd like to bring about here. I have at least four that I've been able to glean from his comments and the direction that he seems to want to take the Fed
Yeah.
that are pretty significant. Um, the first one being basically he wants to basically have the Fed, he's saying the Fed balance sheet has crept into a territory that's essentially fiscal policy,
Mhm.
buying mortgage-backed securities and other things like that, providing currency swap lines, um, reverse repo facility, all these things that he argues are essentially fiscal policy, and they want to limit the Fed buying treasuries, which would shrink the balance sheet materially. And I guess the question that brings into play here is is that giving the Treasury more influence over the Fed's back, um, not less? And that really is I guess unknown at this point, but that's certainly a different a shift from where we're at today. So what are your thoughts on that, Nick? What's your gut tell you?
Yeah. So, and I think you might have cut out for just a second, but basically just talking about QE and how the Fed's balance sheet has expanded over time. Warsh's stance on that, you know, uh, on its face, I think there's a lot of great intuition there. I like the direction that he's heading. Um, because the Fed balance sheet has expanded to a very high level. I think we're somewhere between 6 and 7 trillion right now. Um, and that's basically, picked up since 2008, continued, and then we kind of peaked in COVID and we trailed off a little bit, but hasn't shrunk to the level that I think many would expect it to be, one of those people being Warsh. So on its face, I think that's a good thing. I think that further cements the separation between the Treasury and the central bank. The central bank not always buying up government debt. So I think that's good for Fed independence overall, and I think that's probably better in the long run. And in the short run, the thing that I'm concerned about and want to watch is just how that impacts the market, the yield curve. We've had the Fed as this big buyer in fixed income markets for a long time now, and even Warsh mentions that it's created distortions, and he basically wants the market to take over. In doing that, I think we'll see some pretty meaningful movements in yields, especially further out on the curve, as the central bank tries to shrink their balance sheet. Can you hear me?
There you are. I'm back. Sorry.
Oh, you're good.
That makes that makes sense. Well, yeah, we'll see how that plays out. The other thing, the number two pillar that Warsh is putting out there is that he wants to get rid of the dot plot in the
Yep.
forward guidance, which I think will cause an equally large level of volatility in fixed income markets, right? Because that dot plot is one of the most traded pieces of information in fixed income, right? And
Yep.
I do tend to agree with his reasoning for not providing as much forward guidance. Uh, I mean, it's nice to have that. I guess it provides some less volatility, but sometimes the Fed needs to change path more quickly. And they kind of get into this well, we said we have to do this, so we have to follow through on this. Otherwise, it'll
Yeah.
create volatility. When in reality, they just need to make the best decision. And that's his argument, is that he wants robust deliberation and what I think he called it messier meetings,
Yeah.
where members are not showing up with like rehearsed scripts just to keep markets calm. And I
Yeah.
do tend to agree that that might be a good thing because it allows them to be more flexible and not pre-committed to this policy.
Yeah. No, I tend to agree. I think it's going to be another interesting piece to watch. I know largely he's just been pushing for a little bit less open communication outside of the rate decision, um, for those reasons that you mentioned, basically not wanting to commit to a path ahead of time. And,
Yes.
I think Powell, for the most part, has done a good job of not committing to rate cuts or hikes too early. But that being said, they have kind of created issues for themselves in the past, especially just the central bank as a whole, where they've kind of committed to a path that maybe at the time when the decision's actually going to be made, it's not the optimal one. So adding to that flexibility is nice. You do add some additional uncertainty into the fixed income market, so it wouldn't be surprising to see yields hop around a little bit more
Right.
after that. But on
Right.
its face, I mean, I see the rationale for it, and
Yeah. There's definitely rationale for it, and it connects to his other point of basically wanting fewer meetings and more decisive action. I think the Fed is only actually required to meet 4 times a year.
Mhm.
So I don't think he is saying that they're going to only meet 4 times a year, but he is definitely in favor of fewer meetings and less hand-holding of markets, which will create a little bit more volatility, trading volatility, but maybe it gives them more flexibility to deal with things and make more uh, swift and decisive actions. But we will tell. Time will tell.
Yeah. No. It's definitely, interesting to compare the two. Uh, Warsh just it seems like he's a little bit more aggressive in the moves that he might want to make, willing to change course if he sees that that's the more appropriate action. I think the other way too, the way that they target inflation and think about that is another interesting comparison. I think just highlights the more aggressive nature that Warsh has compared to Powell. You know, Powell, in some of his press conferences, has mentioned wanting to target an average 2% inflation. So back in 2021 and 2020, he was talking about letting inflation run a little bit hot because to make up for lower inflation years that led up to that.
Yeah.
Warsh has criticized that pretty heavily, saying that that's a fatal error, and that they should just be targeting a symmetric 2%,
Yeah.
not allowing for higher inflation to offset lower inflation years as well. So I think most of everything that we see here and what we've talked about so far just points to him being a little bit more aggressive in terms of moves that are going to be made and less um, signaling for what they're going to do so that they have more flexibility.
Yeah. Yeah, agreed. I think he even wants to move to a different inflation measure.
Yeah.
He's hinted
Yeah.
at using some more newer, more frequent data sources, which
Yep.
probably is a good thing. But that would definitely pretty meaningfully, tighten up how the Fed thinks about its success or lack of success. So we'll see there. Yeah, that average inflation, it was hard to gauge. Like, are they actually keeping inflation down, or do they have the liberties to let inflation run hot or let it run under? I don't know. We've had an inflation problem for years now since COVID. So, um, and overall, Powell, I feel like, has done a decent job.
Yeah.
But it's interesting to point out some of the potential changes that are going on here with Warsh and him just not just being a new Fed chair, but legitimately trying to change the regime at the Fed, which has been in place for quite a while now.
Yeah. Certainly. Lots of interesting stuff to unpack there too. I mean, we could talk about this for a long period of time. I mean, him also mainly concerning himself with inflation, talking about how the Fed has drifted in other areas that he doesn't see as um, under their purview as well. Uh, Another interesting thing to dive into, but
Yeah, we'll see.
lots
Will make
there.
for an interesting summer.
Definitely. Definitely. It will
Well, that
certainly.
that leads. I know you had some other stuff that was you wanted to talk through some of the seasonality that we're getting into with the summer, particularly in May. You wanna dive
Yeah.
into that a bit?
Yeah, absolutely. So this is a quick little thing we just wanted to throw together. We haven't heard this from clients specifically. At least I haven't. I've never actually gotten on the phone with anyone and talked to them about selling in May and going away. But that's one of those things you hear out there. People talk about it. I feel like it might, at this point, more just be a news story, filler news story for a slow news day that the financial news broadcasters run through. But wanted to look into it, see if there's any merit to it, and just do a little bit of a study on it. And basically,
I'm not real familiar with the theory here, and I haven't heard a bunch of people commenting on this. I'm aware of different seasonality, but I don't know that I had heard anyone recently say I'm going to sell in May and then hold my portfolio for a while in cash. So what's the premise here? What's the actual date timeline that they're going to sell and go to cash? Because presumably that's what's happening, right? The theory would be once you get to May, sell, and then how long do you stay in cash in this?
Yeah, basically 6 months.
Supposed
So
theory.
you go through the summer, sit in cash or sell out, go to something else. And we'll kind of talk about that too, because I think that's an interesting question. But basically, sell in May, stay in cash through October, buy back in November, and then hold through April is basically the idea there. And it dates back a long ways. They were talking about it back in, I think, the 1800s. And back then, I think it had a little bit more credibility, just because, largely driven by commodity markets, and just the economy was just more agrarian. So it was largely focused around harvest times and driven by the harvest cycle. And then, holiday spending was still a thing, other issues like that. So back, as you look further back, the data that I could see where people were studying it, back in the 1850s, through the early 1900s, it seemed that it had a little bit of it had some credibility to it. The markets behaved that way. And we still kind of see a pronounced trend here that I think is really interesting. I think I would stop short of saying sell in May and go away, basically. But it comes from that, essentially, just more agrarian economy. People who were following the market started talking about selling in May and going away. And basically, most of your market movement occurs in those winter months as opposed to the summer months, for a number of reasons. And we kind of still see a bit of that trend playing out, actually. If we look back to 1989 through today, you can see that if you just hold during the winter months, so this chart that I have here, this blue line, this is just buy and hold S&P 500. Buy and hold S&P 500 total return from 1989 through today, basically. So that's the highest line, buy and hold. That's the big takeaway. Buy and hold seems to be the way to do this. But just for the sake of the study, the winter months do pretty notably outperform the summer months. So this orange line here, this is basically you only are invested in the S&P 500 for those winter months. So November through April. And you're only holding through those months, and then you just sit in cash for the remaining 6 months. This gray line here is the opposite of that. So we're only holding in the summer months, and then we're sitting in cash in the winter months. And all of these lines are positive, but you notice that the majority of these returns for the S&P 500 have come in the winter since 1989. One of the more interesting things to note, too, is that that's kind of broken a little bit more. You can see more of the returns are coming in the summer here more recently, and that's an interesting trend that people have been noticing. So basically, if we look back from today to 1989, there does seem to be some, credibility for that. The winter certainly seems to return a bit more.
Interesting. But the key metric there is buy and hold still significantly outperforms even the best of the other seasonality based portfolio decision making ideas.
Yes, definitely. Yeah, buying and holding is still an important thing to it's paid off throughout that time period. I was trying to come up with some funny rhyme for sell in November. I couldn't come up with anything. If you guys have anything, please let us know. It doesn't seem to be anything you want to do based on this chart, but would love to have a rhyme.
Yeah. Interesting.
But if we dive in a little bit more deep here, just take a look at what the actual returns are for major indices throughout this time period. Again, it just highlights what we were talking about earlier. The best strategy is to stay invested, buy and hold. The average return through summer months for the S&P 500 is 3.6%. It's positive 80% of the time. So of the periods that we looked at, 80% of the summer periods that we're observing from 1989 through today are positive. And I think actually the data that I used for this study is a little bit different than this one. So this is actually 2000 through 2025. So my apologies there. This is looking at 2000 through 2025, but largely the same thing holds. Again, average return is 3.6% from 2000 to 2025 for summer months. When we compare that to winter months, the average return is 5.9%. So there's a pretty notable difference in the average return between summer and winter months.
Yeah.
And again, that just ties to what we saw up here. They're both positive, just one's notably more positive than the other. That being said, what do you do for those summer months if you were to follow this to its conclusion? You know, at 3.6% for 6 months, you're not going to get that in fixed income yields. You're certainly not going to make that in cash. So I feel like the smart thing to do is stay invested. I mean, even though the average is a little bit low, you see years where a meaningful portion of the returns for that year come from the summer, and you certainly don't want to be not invested in 2025 when throughout the summer the S&P 500 returned 23.6%. There's a number of other periods like that as well. So an interesting thing to note, it certainly seems like returns are more muted in the summer. That is reinforced by this, but not to the point where you want to sell out.
Yeah, definitely. It's funny how that tends to be the case. What's the answer is you should just stay invested, buy and hold, do the boring thing.
Yep.
But it's most of the time the right answer.
Yep. And it's funny too. I mean, the ratio of positive to negative periods for the study are largely the same. Now we have an additional data point for November through April, just because we've got 2026 and we haven't had that for 2025 yet. So it's a little bit lower for this, but I find it really interesting that, you know, the percent of these periods that are positive are largely the same for both of these data sets. Just one is a little bit more positive than the other.
Yeah.
So I would not sell in May and go away. I don't know what you would put it in otherwise that would get you the same returns, but an interesting thing to have in your back pocket that typically the winter is where you get more of your returns from. So
yeah. Well, thanks for sharing, Nick. I appreciate it. I like it. Hopefully everybody just stays invested.
Staying invested seems to be the key.
Yeah.
But that's it. I would not sell in May and go away. That's the conclusion.
Stay
Shocker.
invested. Stay invested.
It's a shocker.
Yep. Shocker coming from the quantitative portfolio people.
Yeah, exactly.
Funny. Well, awesome, Nick. Thank you. Should we move on to some trivia and wrap this up for the week?
Let's do it. I almost forgot about trivia.
Oh, I did not forget about trivia. I have two great questions for you this week.
Oh boy. Okay.
I'm just kidding. Well, I do have two questions for you. I don't know if they're great.
I like it. I'm excited.
All right. They're related to the Kevin Warsh. So,
ooh, nice. Okay.
All right. You want me to go ahead?
Yep, go for it.
All right. Kevin Warsh first served on the Federal Reserve Board of Governors from 2006 to 2011. Do you know why he resigned in 2011? And what policy did he oppose?
It was QE, right? QE2.
Yeah.
And he published a paper too, like an NPR
yeah.
Op-ed, or was it NPR, Wall Street Journal op-ed, I think, criticizing it.
Yeah, exactly. It's interesting. He out of institutional loyalty voted for it for QE2, but publicly objected in the Wall Street Journal. He wrote an op op-ed shortly after that, and then stepped down from the board in March of 2011 after that.
Yeah, I find that really funny that he was on the board when they were starting that, and now he's really adamant that he wants to wind it down.
Yeah, exactly. So that's definitely an important. Oh, well, good job, Nick. I kind of thought you get that one right.
Yeah, well, doing the studying for prepping for this, that was one of those things you come across.
Yeah.
I'm going to try and come up, I've got a few here to choose from. I'm going to try and grab some ones that are maybe a little bit more obscure.
Okay.
All right. We've talked about this one. We didn't talk about it today, but Jekyll Island and how the Fed.
What was that? Okay, Jekyll Island. Yep.
Jekyll Island, how the Fed came to be what it is today. But I've got a fun question related to that. 1 second here. Just want to make sure I get my phrasing right. Well, I'll word it however I want. Jekyll Island is located in which US state?
I believe it's South Carolina.
Ooh, close. It's Georgia.
Is it Georgia? Okay.
It's Georgia. Yeah. But close. Very close.
Okay.
Very, very close.
Dang it.
It's probably pretty close.
There's a really good book called The Creature from Jekyll Island. For those that want to understand the Fed, it would be a really good read.
Yeah, we've talked about that one, but I still haven't gotten to read that, but
Yeah.
definitely on my list.
Worthwhile.
It's probably one of those. Oh, no, you're going ahead.
Go ahead, Nick. Sorry, I was done.
Oh, I was just saying it's probably one of those islands that's right on the South Carolina Georgia border.
I think it's close, but I'm not sure. I'm not great on my specific South Carolina Georgia geography.
Yeah. Yep.
All right, I got one more question for you.
All right.
All right, September 2012, when criticizing the Fed's QE program from question 1, Warsh wrote that there was a specific consumer product launch that would have a greater positive economic impact than the Fed's quantitative easing. Do you know what product he was talking about?
Man, in 2012, he was saying this.
He said this in 2012. Yeah. It basically, it's a clue, regardless of whether this product had more of an economic impact than QE. It's definitely a clue as to why he's more bullish on AI productivity gains, supporting lower rates and all that stuff than his hawkish peers.
Yeah, interesting. I mean, I'm trying to think what was coming out in 2012. The iPhone was like 2007, right? So probably not like the smartphone. Although maybe. I'll say the smartphone. I'll say the smartphone. Okay.
Specifically, I'll give you that. That's 2 for 2. Specifically, he was referring to the Apple iPhone 5.
Oh, wow.
So
I wonder why not the 4. What did he have against the 4?
I don't know.
I think the 4. It was nice and substantial. The 5 was like slipped through your hand.
Yeah, that's true. I don't know. But yeah, I think the 5 launch happened in 2012. So he was specifically saying that just that one iPhone launch would do more for the U.S. economic growth than the Fed's bond buying program. So
okay, I guess
yeah,
kind of making fun of it, saying it's not as effective.
Yes,
as it might be. Yeah, that's funny.
Whether you agree with that or not, it definitely gives you a clue as to what he's doing.
Yeah, that's funny. All right, I'm choosing between 2 here. I'm going to go with this. You've asked a lot of questions about Kevin Warsh. I'm going to ask one about him. Kevin Warsh was the youngest Fed governor in the institution's modern history. How old was he when he was appointed?
I'm going to guess 38.
That was close. 35.
Oh, shoot. I almost
35.
guessed 36. 36 was my first guess. I knew he had to be like late 30s. Yeah, very, very young. Wow, 35 years old.
Yeah, impressive.
Yeah, definitely.
Impressive.
Well, lots to be learned here in the next couple months about Mr. Kevin Warsh.
Certainly. All right.
Well, that wraps it for me. You got any other thoughts, Nick?
Nope, that's it. Stay invested. Don't sell in May.
Yep, absolutely. Well, thanks, Nick. Thanks, everybody.
Bye, everyone.
Bye.